Listen up, because we are diving into the ultimate David versus Goliath story in global economics. For decades, there's been this unspoken, unbreakable rule: when Wall Street catches a cold, the rest of the world gets pneumonia. Global banks take wild risks, the market crashes, and smaller economies, they pay the ultimate price. It's treated like a cruel law of nature. But what if it isn't? What if a nation could actually build a shield against the absolute chaos of global finance? Must emerging markets always be Wall Street's victims? The financial elites absolutely want you to think the answer is yes. They tell us that globalization just means accepting the pain when global banks panic. It's supposed to be the cost of doing business, right? Well, today, in this explainer, we are going to completely shatter that myth.
Because in 2008, the answer was yes. Small economies got absolutely crushed. But then, everything flipped. In 2010, South Korea stepped up and proved everyone totally wrong. They rebelled, they fought back, and they won. This is a massive slap in the face to conventional economic wisdom. How did they actually pull it off? Let's look at the hard evidence.
You gotta feel the pain to understand the victory. $50 billion. That is the exact amount of foreign hot money that vanished from South Korea in just 3 short months. The year was 2008. Lehman Brothers collapsed in New York. Instantly, panicked global banks ripped their cash right out of Seoul. It was ruthless, and it was completely devastating.
Look, global capital flows, they aren't some gentle stream. They are a literal tsunami. And in 2008, Korea completely drowned. Global banks were rapidly shedding debt, a panic-driven process called deleveraging. When they yanked their money out, Korea's foreign exchange reserves plummeted. The currency crashed. They were bleeding out. And the craziest part, it wasn't because of anything they did wrong locally. It was because of a panic an entire ocean away.
It's a brilliantly brutal trop. Here's the exact anatomy of the disaster in 3 simple stages. Stage 1, global banks on Wall Street pump massive amounts of cheap liquidity. Stage 2, local banks in places like Korea borrow that cheap money. Stage 3, local borrowers finally get the cash. But here's the sick trick. They also inherit all of the risk. When that cheap money suddenly vanishes, the locals are left holding the bag.
The hard proof is right in the data. There was this massive, totally unnatural spike of foreign banks flooding the world with cheap, highly dangerous US dollar funding. It was pure artificial liquidity. Literally the calm before the storm. Wall Street was basically hooking the rest of the world on cheap debt.
Researchers cut right to the bone here. Korea's fatal weakness? It wasn't a bad local economy. Their businesses were actually crushing it. The fatal weakness was a terrifying addiction to short-term foreign cash. It was a ticking time bomb. And the exact second the global banks hit the panic button, that bomb went off.
But then the script completely flips. In 2010, South Korean policymakers actually stood up. They said, enough. No more playing the passive victim to Wall Street's mood swings. They decided to actively fight back. They didn't just complain to the international community. They built a wall.
Their weapon of choice? Academics use the boring term macroprudential levy, but let's call it what it really is: the tsunami tax, a bold, aggressive 20 basis point penalty designed to punish banks. If a bank wanted to rely on risky short-term foreign hot money, they had to pay up. Korea actively penalized the exact behavior that caused the 2008 crash in the first place.
And this wasn't just some random cash grab, it was a perfectly engineered financial dam. First, they capped leverage. Second, they targeted the toxic, short-term money specifically. And the most brilliant part? The government didn't blow the tax money on random political projects. They locked every single penny away in their foreign exchange reserves. It was a pure shield, built strictly for financial survival.
So here's the million-dollar question. Did it actually work? Could a single, relatively small economy actually go toe-to-toe with the overwhelming power of the global financial system and win? Did their 2010 counterattack actually hold up against Wall Street?
Oh, we don't have to guess. We have the cold, hard data. Researchers ran a massive study across 48 different countries, looking at both advanced and emerging economies. They essentially used the rest of the world as a control group to measure the exact difference in how countries reacted to global shocks before 2010 versus after. And the results? An absolute face slap to conventional wisdom. After 2010, the ASEAN Big Five countries and Australia actually saw their sensitivity to global shocks increase. They became even more vulnerable to Wall Street. But South Korea, their sensitivity decreased. The data is undeniable.
The rest of the region got weaker, while Korea got fundamentally stronger. The contrast is absolutely profound. The rest of the world stayed totally addicted to cheap global liquidity. They just kept chugging the poison. But South Korea, they forced their banking sector to sober up. They forced them to use stable, long-term funding. It is pure smug vindication for those policymakers. The tsunami tax worked exactly as intended.
So here is the massive takeaway. A small nation, actively, intentionally, blocked the devastating effects of Wall Street's leverage cycle. They completely broke the rules. They proved that you do not have to be a passive victim just because you have an open, globalized economy. You can fight the waves. Now, let's keep it real for a second. We don't just blindly worship academic papers in this explainer. This research definitely has flaws. For starters, one of the authors literally helped design the Korean policy. That's a massive conflict of interest. Plus, the statistical models fail to perfectly control for every single domestic event happening in Korea. And they totally ignored the fact that banks probably changed their behavior way before the tax officially started, just anticipating the hit.
But honestly, despite those academic nitpicks, you literally cannot argue with the empirical truth and the data. The macro-level numbers are just too huge to ignore. The structural break is glaringly obvious. The dam actually held back the water. Korea successfully engineered their way completely out of a global trap.
Which leaves us with a pretty chilling thought. Korea built a dam against the world's hot money. They learned from 2008 and actually protected their citizens. But the next global financial crisis, it's not a matter of if, it's when. When Wall Street panics again, will your country be ready, or will you be the ones left holding the bag? Think about it.